Joseph Hogue here. Thank you for joining us for another 3 p.m. live stream here. Loving these Tuesdays and Thursdays live streams at 3 p.m. Eastern. They're just kind of a little bit less formal way to connect with all you out there in the Bowtie Nation, although still wearing the bow tie, I guess. Less formal would be, taking off the tie and cranking open a bottle of Jack Honey with y'all. But loving these, getting that Q&A session going there after we cover the topic, because today is such an important day, not just for those Nvidia earnings, what we're going to talk about, but how is the market reacting to those? And what I think you need to be thinking about when you're thinking about these AI stocks, how to invest in these, and what is the next AI stocks you need to be in. I'm gonna share an analogy for those AI stocks that I think is going to be really important to understand over these next few years as that artificial intelligence revolution develops, and we see different stocks take advantage of this, because it is not always going to be the chip stocks like Nvidia and like a lot of those chip stocks that we're seeing rise over the past few months. So I want to talk about that. If you're new to the community here, don't forget to join the community. Tap that subscribe button. It's free. You'll never miss an episode. Don't forget to watch next tomorrow's video. We got 3 strategies for retirement investing. And I know it's not the sexy stock picking that everybody loves, which stocks to buy now, but it is probably one of the most important videos you'll ever watch, because what are you doing this for? You're investing presumably so you can retire, right? What's the use of getting to retirement, not being able to know that your money is going to be there for you when you need it, or using that traditional 4% retirement strategy and then going broke before you're the age of 75 or 70? Okay, so I'm going to share 3 retirement strategies that are going to guarantee your money is there when you need it. It's going to make it so you can have more money in retirement, even if you haven't saved that much, even if you're a little bit behind in that savings. And it's really going to help you out, though. So make sure you catch that tomorrow, 11:45 Eastern. That's our regular Wednesday and Friday videos come out that time. Great to see all you out there, in the chat there already. Kevin there from Lakeland, real close to where I am right here in Tampa. I don't know if it was raining. We just got over a storm about 5 minutes ago, so I was happy about that. We got the Quags always here. Ambassador Blue Bowtie Nation ambassador. You've been a Bowtie member for so long. Ron, good to see you there. Marcy, hey Keith, good to see you there. One of the investors there from the that we just had a CRT drop just about a month ago there in the for the channel. I want to get to this. If you haven't yet, though, click through. I've left a link there in the chat. I'll put it in the comments and in the description below. It's a free report I put together with the Motley Fool. It's it's totally free. It's just some way to help support the channel, right? It's the 5 stocks that I've invested in for the next 30 years, right? My forever stocks. And in fact, 3 of these stocks are 3 that we're going to talk about today. These have been on my list for quite a few years now. All are up double digits this year, and I think can go even further as that AI revolution develops over the next few years. So if you haven't yet, there is no obligation to buy anything. You just go in there, you put in your email address. You can see the first stock for free right there. On the as you put in your email, they're going to send you by email the next 4. So it's going to be 5 stocks in total, but there's no obligation to buy anything. Of course, Motley Fool is going to try to get you to sign up for their premium advisor program. I've used it in the past. I like the program, but there's no obligation to sign it up. And again, it just kind of helps support the channel, in what we're doing here. So I really appreciate that. I want to get to this topic though, because this is, like I said, I think everybody is focused on these AI stocks right now, especially with Nvidia's earnings today, and we're going to walk through these. But Nvidia isn't always going to be the AI stock to buy, okay? And I think you need to think about this in terms of what is next for AI stocks, for artificial intelligence, how that develops through our economy, and which are the next stocks to buy. Okay, because we look at AI, we look at Nvidia, we look at a lot of those chip stocks, those semiconductor stocks, how they're reacting today to this news on Nvidia, and they are all terrifically overvalued, very expensive right now. So when the AI revolution goes into that next gear that I'm going to talk about, I think you're going to see a lot of weakness in these stocks that are the higher flyers of this year, and a lot of investors left behind chasing what's next. So, but first, I do want to talk about Nvidia's earnings, because they were outstanding. Nvidia here today reported that revenue more than doubled over the last year, and we expected that it would come close. I think they were actually forecasting something like a 60% year-over-year increase. It actually doubled from the last year. And what's even more was the outlook they gave for the current quarter. They said it would be about $16.5 billion in current quarter revenue. That's Q3 revenue, well above the expectations for 13 billion. So, firing on all cylinders, really seeing a lot of demand for those AI chips. And basically, folks, when you think about this, you got to think of this what Nvidia does and a lot of these other semiconductor companies. These semiconductors are chips, right? These are the processing power of a computer. And it's only through the very highly advanced chips that NVIDIA makes. And NVIDIA makes so well, a lot of the other chip companies just can't even touch that level of performance of NVIDIA's chips. That is what is going to be necessary to run AI, the AI programs and software of the future. To top it all off, NVIDIA, of course, also announced a $25 billion share buyback program, which is actually a little worrisome. I know the market loves those buyback programs because they increase earnings per share, and which is, of course, the ultimate valuation for a stock. But anytime you see a company buying back its shares, what is it saying? It's saying, well, we got all this money, all this cash flow. We don't know what to do with it. There are limited growth opportunities. That's something that you generally see in, older, mature companies. Pepsi, you see Pepsi, you see Disney, you see even Apple. Really buying back their shares a lot because of those limited reinvestment opportunities. You don't expect it from something like Nvidia, though. Okay, Nvidia, which is doubling revenue year over year, has this demand for its chips and should be reinvesting in that next generation of chips or just production capacity or whatever it needs to do to continue that speed of revenue growth. And yet it's telling us that it's got this extra $25 billion that it's just going to buy back its shares because it doesn't know what to do with it. Now, it's good to have that kind of problem, but it is something that I think investors should kind of think about and just should kind of look at. You know, it's one thing if it's making so much money that it has enough, more than enough to reinvest and enough to buy back shares. That's one thing. But if it's also running out of reinvestment opportunities, that is something entirely different. So again, just outstanding results there by Nvidia today. But look at what the market is doing. This is crazy and very telling of where the market is right now. So the S&P 500 is down almost 9/10%, now 9/10%, going into the close in about an hour from now. The Nasdaq down 1.3%. You can see over here on just some of the stocks I've been looking at. Palantir Technologies down 6%. Nvidia just up just 1.7%. At one point on the overnight hours, after hours last night, that was up something like 10% in the after hours. We can see some of the most actives here. I believe some of the so advanced micro devices, another chip stock down 7%. Palantir again down 6%. I know Splunk was in there. AI C3.ai down 11%. So we're seeing a massive sell-off in a lot of these chip stocks, a lot of these other AI stocks, and Nvidia only up 1.75%. This is what I was talking about there on in our Monday market update. I talked about it in our live stream Tuesday that the valuations are so stretched on a lot of these chip stocks and even some of the broader AI sector or the AI industry that it just takes amazing news, even more than doubling your revenue year over year and a $25 billion buyback to see any kind of upside. Okay, so I was talking Monday that the upside was limited, downside very much higher, and so I would be kind of covering my bets there in some of those chip stocks that have run up so high this year. I think Nvidia is up something like 233% already this year, which is just amazing. Um, and you see it across the AI complex there. Uh, so I think with that kind of valuation in chip stocks, and especially especially the chip stocks, the semiconductor stocks, you really have to start thinking about, okay, what is next? Okay, you cannot just chase the hot stock of the day and that overcrowded trade that everyone is in. Okay, Nvidia even doubling its revenue year over year, it is still trading at something like 40, 35, 40 times on a price to sales basis, which is unheard of. It's very expensive. It's even higher than other growth names like Tesla, like I believe even like Roblox, a lot of those other, hot growth names. 40, 35 or 40 times revenue is very expensive. I believe it's just an overcrowded trade. And, again, like I said, It is not going to be that part of AI that is benefiting forever, in that investor sentiment. So I want to talk about this. I want to talk about kind of an analogy that maybe helps you understand that. Okay, so if you think about what semiconductors are to this whole trend, to a computer, semiconductors are those chips. That's the brain, the structure brain, or the physical brain of the computer. Okay, it is the processing power, right? You need those high performance chips to be able to process that software, the programs, everything that that computer does. Okay, and I'm not a tech person, but this is just how I've better understood it is that you get those graphics processing cards and things that Nvidia makes, the chips that allow it to be able to process things so fast that it can run these AI programs seamlessly, right? Very very quickly. Now, so why we're seeing so much demand for Nvidia, why it's doubling its revenue year over year, is because everyone is getting ready for to be able to apply all these AI programs and apply these applications to their business. Okay. You've got Google, you've got Amazon, you've got all these other software makers, the gaming companies, all of them trying to develop some kind of AI program and AI software that will be able to, one, lay off half their workforce and save tons of money, right? But also be able to do amazing things in the future, self-driving cars, all kinds of things. So you've got the chips, right? The physical brain of that system. Next, you've got the cloud services, right? Cloud services like Amazon, like Microsoft, like CRM, Salesforce, right? That's kind of the nervous system, okay? The nervous system that runs through your body, connects your brain, and really is kind of the conduits, the highway system, right? For that software to run through. That's kind of how I think about it, right? The cloud servers, obviously, an offsite server that helps serve up some of the information back and forth, right? And then finally, or not finally here, but you've got the software, the AI software, those programs. That's the actual thought, okay? The thought that is going through, that is being processed by the brain, going through the nervous system into the limbs and the senses and things like that. And then finally, you've got the users, right? Who are using these programs? So that's a little bit outside the analogy, I guess. But I think you need to start thinking about it that way and start thinking, okay, if we've got the chips, we've got Nvidia skyrocketing, we've got AMD, we've got Taiwan Semiconductor, all of them doing very well on that chip demand, constructing that physical brain, that infrastructure of AI chips and servers that we need. Then there's going to be a point where there's a slowdown in the demand because they're all created. They've the slowdown in the initial demand for those AI powered chips. Okay, then what's next? Then we have to construct the cloud, the nervous system of that system, and that's those cloud services. So we're going to talk about some stocks in that I think will probably be the next to really benefit from that. And of course, a lot of your cloud services stocks like Microsoft, like Amazon, Salesforce, they're already up double digits. Okay, but I believe, that's nothing compared to what they're really going to see once that real cloud services demand hits for the AI boom. Okay, then you've got software. Okay, and maybe and is probably I don't know if it's a moot point between okay which hits first, cloud or software, because obviously you probably don't need the cloud services quite as much. Obviously, we're still using cloud services already even before AI, but you don't need that AI part of cloud services until you have the software programs to run on them anyway. So whether you have the cloud boom before the software boom, or they're both kind of simultaneously, either way, I think after this chip demand, you've got those cloud services boom and the software. Okay, the company's actually creating the software that is going to run through these chips, that is going to run through those cloud services, through that nervous system infrastructure that we have set up there, and that people are going to be using. So I think that's the next area of stocks that you need to be focused on, right? Because, unless you want to pay 40, 30, 40, 50 times price to sales basis for these chip stocks, so that obviously, if we saw, a company double its sales year over year, uh, you know, excuse me, double its sales year over year, and then forecast probably another double in the current quarter and buy back 25 billion shares. If that only put 1.5% on top of the stock price, then that tells me that that stock is a little bit tapped out, and a lot of the stocks in that chip industry are tapped out. Okay, so you really want to start thinking about those other stocks, those cloud services, the software stocks, things like that. Finally, eventually, we start talking about the users, right? And those users are going to be the companies, most primarily the companies using that AI software to cut their operational costs, and we all know what that means. The jobs that are going to be in jeopardy due to AI. I'm actually going to cover that next Wednesday in a video. The jobs that don't believe all the lies that, oh no, AI isn't going to take your job. It's going to make you more productive. Yeah, because we've heard that one before. We've heard that one many times before, and it always leads to the same thing. So I'm going to cover the 9 stocks to watch and the jobs that are in most in jeopardy from that AI boom. That I believe is still probably a couple of few years down the road. First we have to have the actual software in place. We have to have the cloud system and all that infrastructure, that nervous system infrastructure that we need, to be actually be used by these companies. So I want to talk about some of the stocks within those that cloud services within the software that you can be looking for, to really boom next. And first, I want to show you really just how to find these, because I'm not going to sit here and tell you that this is a report by Goldman Sachs I thought was really interesting. It's saying that generative AI could raise global GDP by 7%, which is an amazing amount, 7%. And I believe that was only through like 2028 or something. So just over the next 5 years, an extra bump of 7% in global GDP. But I want to show you how you could find some of these stocks and kind of do some of this research on your own, because I'm going to talk about 7 stocks here that I'm watching as far as the next step, the next leg in this cloud or in this AI revolution. But you always want to be able to find your own stocks, understand where those are coming from. Um, and what you can do is you just find AI ETFs, right? Exchange traded funds that are focusing on this AI theme. And right now, there is one problem with these: is a lot of them are, instead of focusing exclusively on artificial intelligence or AI, they're focusing on kind of other things like ARC. You got the ARC Q here, which is autonomous tech and robotics ETF. That's um, kind of their go-to AI fund. You've got the Wisdom Tree. They've got the artificial intelligence WTAI, and then you've got the bots, the Global X BOTZ, the robotics and artificial intelligence ETF. So a lot of these are going to be kind of focused a lot on robotics as well, just because that part of the market of the AI market is a little bit more developed. It's already obviously being used. A lot of the companies developing robotics already using them. They don't need all the AI software to run those robotics. So they're already making revenues and earnings. So a lot of these companies, or a lot of these ETFs are focusing on that. But what you can do is you go in here and you look at these and you just go to holdings. Any ETF on its website is always going to have this holdings or positions, anything like that. And it's going to show you exactly what is in that ETF. Now, again, you have to be a little skeptical here, especially with ARK. I don't know what the deal is with ARK, if they feel like they just have to keep creating ETFs and stuff them with whatever they can get inside of them, because some of these are a little suspect, even for an autonomous tech and robotics kind of ETF. That they've got stuff like Deere and Company, which I know Deere is doing some great things with robotics and self-driving tractors, trailers, things like that. So that's kind of a reason why it should be in this autonomous tech ETF, I guess. But it's a little kind of a stretch. It's also in their space exploration ETF, which is a big stretch. Why Deere would be in their space exploration ETF. But anyway, they've got Komatsu in there as well as some of those others. But you can kind of look through here, and obviously, you've got UiPath, their Tesla. They've obviously got that in there for the self-driving, things like that. But I would focus on looking through some of these and saying, okay, UiPath, that is an AI software name. Teradyne is another UI or another AI software name, I believe. And software or hardware, I'd have to check on that one. So you look through these to get ideas of what could be these next AI stocks, really. We'll go here to the WTAI, the Wisdom Tree Artificial Intelligence Innovation Fund. And we can see here these current holdings. I don't know why, for some reason, they just have a drop down here, but you can see here they've got all chip technologies. Obviously, you got Nvidia. I would kind of question any AI fund without a stake in Nvidia right now, whether it's much of an AI fund or not. They've got Meta platforms, so the old Facebook there. A lot of semiconductor names you're going to see here in these AI. in these AI funds because, well, of course, that is just where AI is right now. Like we talked about, we are still constructing that physical brain of the computer that is gonna be able to allow us to run the the software that is the thought, of the AI. So it's going to be mostly a lot of semiconductor names. Again, I think you should bypass those. You need to focus on what's next, not this advanced micro devices, not AMD, great company, not Taiwan Semiconductor Manufacturing, great company also, and probably a good investment just because they make so many of the high performance chips, the fabricator there. But it is old news. It is the overcrowded trade in that chip sector. You've got Alphabet, you've got Microsoft here. This is a good one. This is a really good one for finding those other names that you might want to research further for what is in that AI, artificial intelligence theme. And again, you've also got the bots, the BOTZ, robotics and artificial intelligence. Now, this one is a little bit more focused on those robotics. So you've got things like intuitive surgical, you've got FANUC, things like that. So you really do have to kind of go through here, research, see what the company is actually doing, if it's a robotics company or if it's an actual AI or chips company, something like that. But that's just kind of how to get started in understanding which stocks that you need to research, you need to be following for when that AI revolution really goes into the next step. So I want to talk about, like we started on that analogy, what are some of the stocks that you might be watching here? And we're going to start with that cloud system, right? Again, that's kind of the nervous system that is going to be connecting the brain, the physical brain of the computer to, to get that software and the programs where it needs to go. And there's really three names here that I'm watching. Two of them are pretty obvious. Actually, kind of all three are pretty obvious, but just leading in those cloud services. Microsoft, obviously, a very strong name in cloud services. Amazon is the leader, the undisputed leader in cloud services. So both of those, I think, will do very well. Microsoft is going to show up again on our list somewhere else. So I think Microsoft has multiple points of value here in this AI theme. uh, Amazon as well. A lot of these companies, Amazon, Google, Microsoft, they have, besides just what you see, but besides just their developed revenue generating businesses, they've also got a lot of money in investments, and other developing technologies that they're playing with. Google has Waymo, its Waymo unit, which is its self-driving unit, using that AI and self-driving kind of thing. So not necessarily something you usually think about for Google, but also a way that it's developing into this AI theme. So something you definitely need to watch. CRM or Salesforce. So that's and we can actually, I'll show you the tickers on these just to make sure you're able to see what those are. Oh, here's okay. So for the big oops of the day, I guess, and this is what I was talking about Tuesday. Somebody asked about a Kathy Wood, an ARC fund, I guess, what I thought about the ARC funds, and like I said, uh, I love the research that they put out there at ARK Invest. Kathy Woods is a good investor. She's got a great team there on her staff. I don't like how they're managing those funds, though. They're managing those funds like a short-term day trader or something, right? And they're missing out on a lot. If you look over the last couple of years, especially after the bust started happening in those growth stocks, Kathy Wood and her team there at ARK have just been missing out big time. They will sell something like we saw here. They sold a big chunk of that Nvidia stock before earnings, right? And so they missed out on. It's not a wasn't a big gain today, but like we said, it was as much as 10% up on the overnight session. It was, even early session today, it was up 5-6%. She could have made another 5 or 6% on what was a very big position earlier on in the year. So she's been selling all the way up into the top for her Nvidia. And we've seen this in a lot of the stocks they've had in those ARK Invest funds. They sell them, and then 2 or 3 or 4 days later, the stock gets a big boost. They missed it in Virgin Galactic, they missed it in a lot of those other stocks. So I do like the research with ARK Invest. I think you can go to the site, look at the research, look at some of the holdings in the fund, get an idea of maybe what you want to research and what you might want to invest in later on down the road as an individual stock. But the fees are just so high on the funds, and they're managing the. If you look at the comparison of the fund's performance versus even just the Nasdaq 100, it has lagged pretty badly a lot of times because they're just missing out on so many of these. But anyway, back to our stocks here, and I want to show you the tickers and the things for some of these. So we've got Salesforce. Salesforce is probably one of my biggest forever stocks, right? And it's not a company you generally think about just because it's not really a retail company. It is an enterprise company, but they are big into human resources, sale, customer relationships management, things like that. We're really the default leader in its industry, and big into that AI drive, right? So I think and cloud services. So I think this is one of the prime companies that really benefits when AI comes to cloud services. Okay, obviously you've also got Amazon, which is the undisputed leader in cloud services, right? They own, I think, what is it, like 20, 30%, maybe even more, maybe 40% of the cloud services, enterprise cloud services market. Amazon's going to own the world, folks. So you have got to own shares of Amazon. Obviously, disclosure: I own shares of Amazon because yeah, there's no avoiding Amazon, and you really don't want to, right? We finally signed up for Prime here at the house just because we were paying something like $30 or $40 a month in shipping costs anyway. After they started charging for shipping, so we went ahead and signed up for Prime. And no, we're actually saving money now because of shipping on that. Amazon, just besides like what I talked about, Amazon is so much more than just the e-commerce and the cloud services. I think it's undervalued here just based on those two, based on e-commerce and cloud services, but it is so much more with all the investments in other technology and the side projects that they have going. Obviously, you've got Microsoft also, Mr. Softy, ticker MSFT. They've got an AI in on OpenAI, right? So they were one of the first investors in that company, that OpenAI, which is the company that created that Chat GPT. They are now putting that into their now putting in that into Bing search, and it's going to be really interesting to see if they can increase their market share in search. Obviously, Google for the longest time has been the overall dominant leader in internet search. I think Bing is actually going to be chipping away at that with that AI that it's been using with ChatGPT, and they're putting it into Microsoft Office. I've already seen it. I'll be writing my scripts for videos, and I've noticed the change in what it's able to recommend as far as text and content. So I think those are the three: Microsoft, Amazon, and CRM that you really need to be watching for in that next leg of artificial intelligence when it hits into cloud services. And obviously, it's already started affecting demand for cloud services, started pushing that up. But I think it's really going to be growing here in the future. As far as software, now of course, remember software. Obviously, that's the thought. That's the actual thing that we're doing. We're spending so much time right now watching these chip stocks, watching these even cloud services stocks, the infrastructure for that AI, that we haven't even really thought quite as much about the actual AI that we're going to be using. Okay, and who's going to be developing that, and who's going to be benefiting from that. Okay, so I know obviously Palantir. And a lot of these companies have had very good years, but they're down now. I think this is giving us an opportunity, a chance to get into this next leg of AI, at better valuations, right? You see here, Palantir down 7% today. Palantir, obviously the leader in government AI, a lot of high level contracts, things like that. Also watching Unity Software. Unity Software doing some really interesting things as far as video and AI video and productions, things like that. Unity Software working with. I know they're working with Disney, Marvel with a lot of their movies, helping them do a lot of the video stuff there. Path, UiPath, also another one I would be watching. UiPath, and all of these down 4, 5, 10% today. Even AI, so C3 dot AI down. I believe that was down like 10% last time we checked, down 12% now. So, obviously these have come up quite a bit already this year, are pretty expensive valuations, but we're getting a 12% discount today. And I do believe, these are going to be the next companies to really hit as that AI software is actually produced and is demanded by their customers. Last one here, and I'm going to revisit Microsoft. Microsoft, just on its gaming alone, right? Microsoft is, making headway into its acquisition of Activision, right? For the longest time, it was trying to close that deal to acquire Activision. It just recently made some changes to be able to clear the UK regulator. It had already cleared or had gotten approval from the US, the FTC. So I believe it is going to be able to close that Activision deal and going to make it just, a leader in gaming. So what I'm looking for a lot of times, and a lot of you in the out there in the Bowtie Nation know this, what I'm looking for in these stocks that I want to buy is, okay, a growth industry, and then the leader in that growth industry, right? So I want growth on top of my growth. And Microsoft moving into gaming now, it's obviously lagging the on the console wars. It's lost the console wars against Sony, against some of the other what's the other console? What do we got? Nintendo, and that it's lost that. Xbox, is probably a distant third compared to those two. Still a good console, and still good demand, but it's quite a bit lower demand for the console itself. But it has, so much more it can provide through that. I think Microsoft is going to be using the Xbox as really a conduit for a lot of the other services and products it's going to be selling. So I think it's really going to benefit from there. It did give Ubisoft like a 15-year terms. PlayStation, there you go. Um, it did give Ubisoft a 15-year terms on a lot of the games. That was kind of necessary to pass the UK regulator that was saying that Microsoft was going to have with Xbox and with Activision was going to have too much control over the gaming market. So it had to give up a little bit of control there, but it's really looking at the long term. Okay, after those 15 years, it's going to have complete control over this, and I think it's really going to be able to use that to its advantage. And I think AI is going to affect gaming probably really one of the first real industries to affected by AI. Okay, we always seem to think about how we can play with something, how we can get entertained by something before we actually think about how to use it in other industries. And I think so that's going to happen in gaming, and I think Microsoft is really the one you want to be watching for in there. Now, of course, after all that has happened, after we have the software, after we have the infrastructure with the cloud services, the chips, demand for AI, then we have the users. And again, that's going to be the companies that are using this to increase their productivity at the same time as decreasing their operating costs. But again, that's going to be something we're going to be talking about next Wednesday in a video about the jobs most affected by AI, as well as the stocks to watch that if you're going to lose your job, you better be rich before that happens. And I think these are the stocks that are going to make that happen. I want to turn it over into the question and answer now. Really, my favorite part of the live stream. Just kind of reach out to you, see what questions you got there. And so I'm going to scroll up. What do we got for questions? If I don't see your question there, then go ahead and ask it again with a question mark, so I know that it is a question. So yeah, a lot of you out there in the Bowtie Nation, good to see you. Robbie Todd there from Cleveland. I see you from New York. Let me invest a corp, Cassone. Good to see you. LJ from Chicago. What else we got? Dragon from say Christopher our savior. That might be a bit much, but I appreciate it. Donkey Donks talking about ARM there, the ARM IPO. That's going to be a huge IPO, one that I've been watching for a long time. It's probably September at the earliest. I'm thinking it's going to be probably late September, early maybe in even October or November before that ARM IPO is actually happens. And it's tough because we see the valuations, we see this overcrowded trade in chips. um, but ARM is just so dominant, in that AI space. And in fact, Nvidia tried to acquire ARM, which would have just created just a beast. So it's probably rightly so that it was blocked in acquiring ARM, because that would have been all over for semiconductor companies. Then it just would have been Nvidia, and that's it. But so it would be really interesting to own, both Nvidia and ARM as kind of the chip stocks to own. But so I'm not quite so sure ARM is it though, because as we're talking about here, they're so expensive. That is going to be probably a 50-60 billion dollar IPO. So a 50-60 billion dollar company already. We'll see what it does when it does IPO though. So that's interesting. What's a price point? So the question, what's a price point you'd be comfortable with to buy Nvidia? That is a tough one, right? Because you all know, you all out there know I am a cheap ass. I do not want to pay 40 times price to sales for my stocks. And we can see that is where Nvidia is trading. Maybe it's a little bit lower, obviously with that doubling of revenue over the last year. But Nvidia here at $475 now up just 0.6%, the 0.6% up even on that outstanding earnings they had today. So that really tells you something about the valuation, about how overcrowded this trade is. But here you see 45 times price to sales. I believe that's obviously that's not updated for for the trailing 12-month sales that they just reported today. But my all you out there in the nation, my rule is nothing over 10 times price to sales. Now, obviously, we are not going to see that in Nvidia. There's no way in hell we're going to see that in Nvidia probably ever, or at least for many, many years. I mean, if we did 45, we would have to see $105 per share for Nvidia, which I believe it actually was there, earlier this year or maybe late last year. Here we go, late last year. Late last year, it hit 112. It looks like in October. That is very close. Of course, sales were lower then, so it was still over that 10 times price to sales, but it was very close to around there. I don't believe we're going to see that here in for many many years though. So obviously I wouldn't wait for 10 times price to sales to buy into shares of Nvidia. I think obviously they are dominant in that chip, that chip demand for AI. Even as that chip demand kind of slows down a little bit as it gets kind of a little saturated, I think there's going to be chip demand for for Nvidia for many many years, obviously. So I would probably be more comfortable with. I mean, we'd and again, remember, I'm cheap here, folks. So if I said like 30 times on a price to sales, um, that would be something like 472. That would be something like maybe 320, 350, which would obviously be a huge discount to where the shares are trading now. That would be something like a 30% discount. I can't say I can't recommend you waiting till that long. If you want to buy shares of Nvidia, I think the best way to do it is probably just to put, half of what you want to invest. Say you want to invest $1,000 into Nvidia, maybe you put $500 into it now, hold the other 500 for, over the next 3 months and then over the next 6 months. Okay. And then just invest every single month, $50 or whatever, and invest a little bit every single month. Okay. Because that way, you're going to be able to take advantage of the upside if it just keeps on going up forever ad infinitum, infinity. You're going to keep on, you're going to benefit from that. If it falls, you're going to benefit from that as well. Every month, you're going to buy a little bit more. You're going to cost average yourself down, and you're going to make money over the long term. I think that's really what you got to do for some of these just crazy expensive stocks that are dominating their growth industry. So that's probably what you want to do with Nvidia if you really, really want to buy into it and you're tired of waiting. For myself, I would give it more time. Okay, I would give it till at least maybe 35 times price to sales or something. And again, that just seems so incredibly high to me, that it's hard buying shares. But of course, they've proven us all wrong with those sales estimates and forecasts. So it's a tough one to crack. That's why I'm saying, hey, you know what? You don't have to make a decision. You get in early on some of these other stocks that are going to be the next AI boom. Okay, these cloud services stocks, these software stocks, those are going to be the next big beneficiaries of this boom. This is an overcrowded trade here in these chip stocks, so you don't feel like you have to be in these chip stocks just to be in AI. You need to be ahead of the market, even if it takes a year or two for the rest of the market to catch up and push these stocks higher. These are going to be the stocks that are going to benefit. What else? Uh, so Duncan from Idaho says he'd rather have them invest that 25 billion. Right. Well, I'd rather them invest that 25 billion in dividend companies. Now that would be interesting if Nvidia, instead of buying back its own stock, invested in dividend companies, kind of like starting a Berkshire Hathaway portfolio or something. I doubt that they're going to do that, but would definitely be an interesting strategy for them, or just to invest in other, other AI companies, right? Okay, so iHungry asks, are there any advantages to a traditional IRA? Let's take this back here. Are there any advantages to a traditional IRA for a low income earner, but expecting to earn more later? Okay, so the the traditional idea, or the wisdom, right? The conventional wisdom, we'll call it, for decision between a traditional IRA and a Roth IRA, right? Is the traditional IRA, you get the tax discount now, or the deferral, right? You get a tax write-off. You say you put $6,000 in your IRA account each year. You get to take that $6,000 off of your income. You don't have to pay taxes on it that year, but you have to pay taxes as income when you take it out in retirement. Now, compare that with a Roth IRA, where you can put $6,000 in a Roth IRA now, but you're paying taxes on that income. So, maybe it's only like 5,000, right, after taxes. Um, but then in retirement, you get that tax-free income, which is pretty nice. So the conventional wisdom there is, to decide which one, because you've got that limit that you can put in either one, each year, right? You can only put, I think it's like 6,500 is the limit right now. You put 6,500 in one, or split it apart in both. You can put it in both. You put 3,000 in one and 3,500 in the other. But you can only add up to like 6,500 in both of those. But the conventional wisdom is that, okay, what's your tax rate now for your income taxes, and what is it going to be in retirement? Do you have a ton of investments, income investments like rental properties and things like that, or whatever, something that's going to boost your income in retirement? You're going to pay more taxes, a higher tax rate then, right, versus now. Okay, or a lot of people like to kind of plan their tax rate year to year, so they can, have a lower tax rate in any given year. Anyway, but so the idea is that if you've got low income, low tax rate now, then you really don't need the deferral, right? You don't need that instant advantage. But if you're going to be making good money in the future, you're going to want more tax break there. You don't want to be paying taxes there in the future or in retirement. Then you would do a Roth now, right? So you'd pay your taxes now, put it in the Roth, and then have that tax free in retirement. Vice versa, if you've got high tax rate now, high income, then you get that instant deduction now with a traditional IRA, and then just pay your taxes later when it's lower in retirement. And for most people, for a lot of people, or probably most people, your taxes are going to be lower in retirement, just because you're not working, so all you've got is your Social Security and your investments to live on. Um, so the question though is, are there any advantages for a traditional IRA for that low income earner? So even if your taxes are low right now, why would you invest in a traditional IRA? And I would say one is just because you never really know. You never really know where your taxes are going to be in the future. So I like to kind of do both, right? I like to try to split them apart each year. Maybe you preference one that is going to help you more in your tax situation. So for a low income earner, you put more in a Roth IRA right now, each year, but you'd still put, maybe $1,000 or two in a traditional IRA. That's just because, it's always nice to have that flexibility in retirement. Okay, some retirement, you can take some of the money out of your Roth IRA that's not taxed. So then that money you're taking out of the traditional IRA, your tax rate isn't going to be as high, because you're living a little bit at least on that Roth IRA money, right? That income tax free money that's not adding up your income and not adding up to that tax rate, right? So it's nice to have both. You never know where income tax rates are going to be in the future. Looking at the finances of the United States, I gotta bet that tax rates are going to be higher in the future. So you do want some of that tax-free money from a Roth account as well. But it's just nice to have a little bit of that flexibility. Uh, what else? Daniel, hope you're doing well too, bud. What else? Could you explain the APE and AMC situation at the moment? Daniel wants to know about the AMC and APE. So many people are saying CEO screwed everybody, but not sure what that means. APE still going. Yeah, I mean, that conversion was, I believe the conversion was planned for today. I think it's like aftermarket or something, but the see if we got still got two tickers. So we still have Yep, we still have two ticker symbols, but they did do the 10 for 1 split or the 1 for 10 split, right? So you see here shares of AMC Entertainment, so ticker AMC now trading for $14.50. It did not go up to $14.50. Okay, so folks that were holding it yesterday, it was like $1.80. It did not go up that much. It just split 1 for 10. So basically, uh, if you had 100 shares yesterday, then you have 10 shares now today, right? So basically you've got about the same, although it did go down 26%. So you're about 26% down from yesterday. And again, a lot of companies will do this. Reverse split is what it's called to be able to meet listing requirements for the exchanges. For the exchanges, you have to have a stock price above $1. You have to have certain volume requirements, things like that. It wasn't really too much of an issue for AMC, but it did need to do that reverse split to be able to convert those preferred shares from preferred shares into common shares because of the founding documents for AMC. It could not create more new common shares. It couldn't just create more shares to sell out in the market, which it sorely needed. It badly needed funding, through more shares. It couldn't do that, so it created those preferred shares, those ape shares, and then with the express intent that it could just convert those into common shares. So kind of a backdoor method of creating more shares, more common shares for the company, raising the funding which it needs and still needs really, but then went through all those legal troubles trying to convert those. At this point, I would be so they are going to convert those. They've done that reverse stock split. They're still the two ticker symbols, but they're now going to convert the ape shares into common shares. But I would and it's hard to say stay away because I know sure as shit if I say stay away, if I say I'm not investing, tomorrow it's going to be up like 40 or 50%, and people are going to say, "Oh, well, you told me not to invest. I missed out on thousands of dollars. Thanks a lot." Well, I mean, I never said I was clairvoyant here, folks. I said I've got more than 10 years professional experience as an equity analyst, worked venture capital, worked private wealth management, CFA charter holder. I've spent a lot of time, in analysis, modeling, cash flow modeling, not real modeling, but working in this industry, I can make pretty good decisions, but I can't tell you the future. Okay, so all that being said, just from my own perspective as an investor, it's hard to see. It's hard to see much from AMC Entertainment, especially since it appears a lot of those meme traders, a lot of the Reddit traders have kind of left it, right? You would expect a little bit stronger response, positive response, one of these days to that, but it has just been falling, nonstop this whole week, right? You see here, Friday. Friday it closed about $35 on that split adjusted basis, so that would have been about 350 Friday. It was even higher before that, but so August 10th. So even about 10 days ago, it was up as high as $45. So from 450 a share, and it's just successively fallen. We haven't even had a good rebound day in that stock. So what was happening? Obviously, everybody that's been following this, those meme stock traders and the Reddit traders have been jumping in every once in a while to really boost the stock up and scare the short sellers. That hasn't happened. So it's really disturbing that they haven't done that. Maybe they've abandoned it. Again, I can't say that they won't come back in, drive this thing up, two or three fold, but I think the risk is just outweighing the reward here. Okay, if you look at the long term operational health of this company, it is still very much in jeopardy. If you go to finances here, and this is obviously this is long-term analysis for very much a short-term stock. Okay, everyone investing in AMC right now is investing on that short-term idea that, hey, Reddit's going to jump in and I'm going to make 25, 30, 40% in a day or two. So everybody's investing that. I'm looking at the long term though, because who the hell knows what's going to happen in the short term. So I'm looking at the long term, and I'm seeing, okay, even here back in 2019, if you look at what the net income, well, hell, even in 2019, net income was negative. Okay, it lost $149 million there in 2019 before the pandemic. Okay, and then obviously you can see the losses since then. But if you look here in 2019, it lost $150 million. It had not okay interest expense. It paid. What we got here? interest expense. So it paid 340 million. I want to make sure they don't have other interest expense here, some other where, other place. But this should be the interest expense. It paid $340 million in interest expense on what we'll look at here on the balance sheet. We want to look at liabilities, and this is what's really going to be the killer for this company, in over the next couple of years. If you look at it, long-term debt. So okay, well, I see what they did. Okay, so it had as much as $10 billion in debt. It paid a lot of that off with that preferred share conversion. So basically, it paid off its debt with the ape shares conversion. Now, okay, so not quite where I was going. Where I was going with that is like a lot of the airlines from time to time, like a lot of these cruise lines. Cruise lines is a big problem here with all this new debt. They were barely profitable before the pandemic. Now they've got tens of billions of dollars more in debt, and there's just no way they're going to be ever going to be profitable again. Okay, so you really got to watch a lot of these kind of meme pandemic recovery stocks. They might be doing very well over the last year or two, but that debt is just going to be a killer. Now, AMC, it appears that they raised money through that ape preferred share and paid off their debt. Not necessarily a problem with the debt anymore, but now they've got so many shares that it's spread across so many more investors. So it's hard to say that AMC is ever really going to go anywhere, or is just going to be dead money unless the meme traders and Reddit can come to the rescue again. So I know, long story short, I'm not investing in it. I did invest in the ape shares before the conversion, rode that up, to a nice little profit. We talked about that quite a bit while we were doing it, but that's over now, and I just don't see any kind of an arbitrage play on those anymore. Okay. Punisher wants to know, do you care to speak about ARM Holdings that about to go IPO in the US? Again, we just talked about that a little bit earlier. If you want to watch the video, after it's live, really not much to say just yet. ARM is dominant in that AI theme, really, along with Nvidia. Nvidia tried to acquire them, which would have created just too big of a giant. That's why they were stopped on that. So it is a company to own when it IPOs. The problem is, of course, as we've seen with these chip stocks, is just going to be so terrifically overvalued that I think I would rather look like I've been talking about. In this, you want to look at that next leg in AI. You want to be looking at the cloud services. You want to be looking at the software, and eventually, you want to be looking at the users of that as those next big beneficiaries of AI. Don't jump into a crowded trade. Think about where the market is going to be next, and get there early. What else? Every time I scroll down and the scroll just jumps, so I miss a lot of them. Okay, here we go. So why is she trading her position? Yeah. So C4 Blaze talking about we talked about Kathy Wood and ARK. She trades her position so often, and a lot of times, especially when the shares fall and people sell out of their shares, they have to redeem some of the stock to pay those distributions. If they don't have cash on hand to be able to pay those distributions, and that causes them to kind of have to reevaluate which stocks they're in. We're talking about ARK Invest here and their ETFs. They have to sell some of their stocks, and maybe they want to push more money into other stocks. So it just causes them to really short term trade a lot of what should be long term positions. I mean, these growth stocks that they own in ARK Invest funds, a lot of these growth themes, those are something you want to give them 2, 3, 5 years even, to really prove that growth theory, that growth idea. And they're just not able to do that, and they're missing out on a lot of the gains that they should be. They should be booking in a lot of these. Okay, what is the AI stock at a value? Which is the AI stock at great valuation right now? Looking to add and diversify my. Okay, so Alexandra wants to know which AI stock to add. We just talked about seven there. I think seven that are going to be the next AI stocks. And what I like about these is, like you point out there, is good valuations. For a cheapo like myself that just can't take himself to can't push himself to buy shares of Nvidia when it's trading at 40 plus price to earnings. I can look at some of these other stocks, these cloud stocks, these software stocks that while they still are trading at maybe 7, 8, even 10 times and 15 times price to sales, it's quite a bit lower than what we're seeing there in those chip stocks. So a lot of those are the ones you want to look at. Okay, I got some single stock requests there. LHX, not sure. HIMS, a lot of these, not stocks that I've covered or that I've looked at. So it's really hard to give you a quick 10-second recommendation on a stock because that's just not how it's not how you should invest. Some Yahoo on a bow tie tells you, hey, buy LAX, buy LHX because it's going up. We see a lot of that on YouTube. You see a lot of channels just say, "Hey, the stock's going up, buy that," and they've done no other research on that, which is clearly not the way to invest. And I'm not gonna put you down that road by trying to tell you to invest in something. Marcy, any hope for Zoom? I know they did actually did very well on their earnings. They're talking about a new business line for Zoom communications. There is a lot of competition there. There's it's a lot of competition, and I don't believe they do. They dominate that industry or have the competitive advantage to really dominate that industry. Microsoft does it just as well. Google has their own voice conferencing kind of thing going. So Zoom. I'm not sure. I'm not sure it can ever be what it once was unless it finds something, the next big thing that it can dominate, that it can have a competitive advantage. Okay, folks, that's what I'm talking about with a lot of these forever stocks or a lot of these stocks you really want to focus on is not just that growth industry like virtual conferencing, like telehealth, like payment systems or something like that. Or AI, obviously, you want to look at the companies that have a competitive advantage, something that is defensible, that is helping them grab market share, take market share from their competitors because they're just doing it so well. Okay. By automakers, FUAW strikes. Okay, so that's an interesting one. Jay Hurd wants to know, should you buy automakers if the UAW strikes? That would be kind of counterintuitive, right? Because if the UAW strikes, obviously, it's going to hurt production. Therefore, the automakers, it's going to mean that, the union there at UAW is probably striking for higher benefits and wages and things that the automakers didn't want to give them. So I don't know, that would be counterintuitive, I guess, if you were expecting, if a strike led to a sell off in those shares, so Ford, Toyota, GM, all those stocks, if a strike really led to a big sell off in those, and maybe if it gave you the opportunity to get in at a lower valuation. I do like some of the legacy automakers here, Toyota especially with its new hydrogen technology, things like that. It's trading fairly attractively. Ford and GM trade very attractively on a price to sales basis, and they're doing very well, developing their EV aspirations. I don't know though. I don't know that a UAW strike would really get me that much more into the shares than or get me more positive on the shares anyway. It's a very distinct possibility. The unions have gotten a lot of power here over the last few years. We just saw UPS was pretty much forced to settle their strike with the Teamsters and pay out drivers 170,000 a year in pay and benefits, and not saying it's not a job where they don't deserve every penny that they make because it is hot as hell outside. And I wouldn't want to do it for less than probably 170,000. But the unions are squeezing the ever loving shit out of companies right now, folks. And any kind of union company or unionized company where it has unionized labor, it's feeling it, right? It's feeling it on those profit margins. So you got to kind of worry about that. It shut down a hundred plus year old company in yellow trucking that went bankrupt because of it. So you got to watch the unionized labor in these companies and their profit margin, especially with those. Okay, so just talked about AMC there. Harry Super Microcomputer Inc. What do you think of this stock? Dipped 35% recently. Buy the dip. Okay, Super Microcomputer. It's a lot of the chip stocks, the hardware stocks there we're talking about. I think you got to look at its market share in that chip area. Why it dropped 35%. If it dropped 35%, there's probably a reason, and you need to really take time to understand why people are selling and why it might be justified. Okay, but more than that, and what we've been talking about here is really uh, don't feel like you have to rush into that overcrowded chip trade. Okay, chips, semiconductor companies are extremely cyclical. They have those big rough, those big roller coaster ups and downs, along the chip cycle and the chip production cycle. I just think we're up towards the peak of that chip cycle right now. So don't feel like you have to jump in these AI stocks, these chip stocks, just because everyone's buying into them. I would rather you go a little bit further out on the timeline, find some of those stocks that are going to benefit from AI further on down the road, even if it's a year or 2 years down the road, and you have to wait a little bit longer. You're going to get better valuations, and you're going to get in on them then. Okay, we got a $5 super chat from Jackie. I appreciate that. Should I buy Berkshire or ETF? Was looking for a new position. Okay, I mean, obviously, a lot of that goes into what else is in your portfolio. What is it going to fill out? If you're looking for a good overall market ETF, Berkshire Hathaway is basically an ETF, right? Owns so many positions. I think Berkshire Warren Buffett right now owns 54 positions, somewhere around there, over 50 positions, right? 50 stocks. It is very heavily concentrated on a few, and in fact, we can go in here and I can show you how to find the positions for Berkshire Hathaway. CNBC has a great Buffett tracker. Buffett portfolio. So go here to Google Buffett portfolio, Buffett tracker. You go there, and it's going to be the Berkshire Hathaway portfolio tracker, and this is going to show you, where his positions are. I can extend this so you can see it a little bit better. Okay, so these are all the positions there in that Berkshire Hathaway portfolio. They're going to show you, it gives you some updates for how much he's increased or decreased things. You can increase this by stake or percentage of the portfolio. We'll do percentage of the portfolio just to show you where it's concentrated at. And what I don't like about the Berkshire portfolio is it has almost half, 46% in Apple. Okay, so we've got almost half. Basically, it is an Apple tracking fund with some financials and dividend stocks to boot, right? To kind of top it off. So you've got, 8.5% Bank of America, 6.7% Coke, American Express, 5.5 Chevron. So beyond Apple, it is a fairly diversified, ETF in the rest of these, right? All kind of mature dividend paying industries. But then you got Apple that really controls it, dominates it. So, I mean, that's one reason why I've never really invested in Berkshire Hathaway, just because it is so overly concentrated in Apple. If I want an investment in Apple, I'll buy Apple shares directly, and not have to do it through Berkshire Hathaway. I guess buying Berkshire is kind of an Apple investment with a safety kicker, right? Because you've got all these other companies, these mature dividend paying companies to kind of smooth it out, which actually might not be a bad way to think about it. But so between Berkshire or another ETF, maybe you go with another ETF. It depends on what you want, what you need in your portfolio. Probably more importantly, if you've got a lot of tech stocks, a lot of growth stocks, then maybe you need a dividend paying ETF. Maybe you need a value stock ETF, something to kind of smooth out those ups and downs with your tech stocks, right? Conversely, if you've only got a lot of value stocks or dividend paying stocks, things like that, maybe you want a little bit of growth, right? With a tech ETF, maybe the VUG, like the Vanguard Growth Fund, something like that. And what I'm getting at, folks, is, how you invest is so much more important than what you invest in. Okay, we love talking about stocks to pick. We love looking at for the next big hot stock, but that how you invest, okay, how you set up your portfolio is going to make all the difference. Okay, and what I mean here is talking about this specifically. What ETF you should buy to really fit with your portfolio is, if you've got all tech stocks right now, if you've got all those chip stocks, those AI stocks, and things like that, you've been having a great year. But if they crash, what happens? Do you get scared? Do you panic and sell out of those? A lot of those at a loss, sometimes. So if that's something that you'd be worried about, then yeah, maybe you would want to diversify into maybe some dividend ETFs or some value stock ETFs, something to smooth out your portfolio a little bit so that when your chip stocks do fall, or when your hot growth stocks do fall, then your portfolio value doesn't fall quite as much because it's smoothed out a little bit with that diversification into some of those other ETFs, those other themes or stock strategies, right? So much more important because it's going to save you the pain of the lost sleep. When the stock market does crash or something like that, or conversely, of course, if you're all in on dividend stocks and value stocks and things like that, and the asshole cab driver is telling you how much money he's making in Nvidia and these growth stocks and these tech stocks, you're going to feel like crap because your dividend stocks aren't going anywhere, or maybe they're only going up 5 or 10% a year, and you're making those paltry dividends, and you're going to feel bad that you're missing out, and maybe you're going to jump in or too late on a lot of those chip stocks or whatever, right? So you really do need to think about what fits with your portfolio, what are the gaps in your portfolio, what you need in that, and then buy into that, right? So much more important that how of investing than always trying to find, okay, what's the next hot stock, or what stock do I buy with that? So good question, great question though. What else do we have? Are safe with the clap switching cheap? You're just a value investor. Yeah, Ron says I'm not cheap. Yeah, I'm just a value investor, and that's true. I am a born again value investor, right? Out of the Marine Corps, a new investor. I was in the momentum stocks, the growth stocks. I was going to be rich overnight. I learned those lessons. Obviously, losing a lot of money chasing the momentum stocks and that strategy. And kind of went, probably too far the other way, too far into value investing and not enough in growth investing. I think you really need that balance, in your strategy and in your portfolio is growth and value. Okay. What else do we have here? Good price for Ford stock. So Jay Hurd wants to know about Ford stock. Again, I do like the legacy automakers, especially Ford. Ford just kind of, it seems like they're still trying to work out some of the kinks to the F-150, the Lightning, right? The electric version of the F-150. But folks, the F-150 has been the top selling truck, the top selling car in the United States for decades. Okay, it has got some huge brand awareness, some huge brand strength. And I believe, once it finally does perfect that Lightning, that F-150 EV, it is going to really surprise the market how fast those sell. Because people, old F-150 owners are going to want to upgrade into that Lightning. So I think Ford's probably the legacy automakers, if not Toyota. Toyota's kind of my lottery ticket because with the hydrogen technology, if that happens to work out and become the next thing, then maybe you want some shares of Toyota. But Ford, among the legacy automakers, I think Ford could really do well, especially over the next few years on EV. So, Daniel wants to know: is the American dream still alive? The dream is what you make it, buddy. It's still there. It is for me. I know it is. And I still believe it is there for a lot of people, but I really don't have any kind of insight or wisdom into that. What do you think of TTOO? So tattooed chef, right? I believe is TTOO. I've never really talked about it. I know T2 Biosystems. I guess tattooed chef is TCEF. I think T2 Biosystems, haven't really looked at that either. $117 million company, so a very small penny stock company, 35 cents a share. Good volume trading, so it's not necessarily one that's too volatile, but I mean, down 26% today. I would have to see. I would have to look more into it to be able to give you any kind of a recommendation. I know that's wholly unsatisfying, but down 26% today. I'm sure that's partially for a reason, and I'd be amiss to just say, oh wow, 26% down. That's a great value, and to recommend it. Okay, Disney is killing my Disney is killing my portfolio. Blame Han Solo dying. Han Solo died, what, like 10 years ago was that movie. That is not Han Solo's fault, man. That is, and if nothing else, that's Kylo Ren's his son's fault, right, for killing him, I guess. Disney is an interesting one because Disney does have some very strong assets, obviously very strong brand recognition. I think they are, besides Netflix, probably the streaming company to own. But it's been tough for Disney over the last year, really kind of getting pulled into kind of a politicization. It's hard to even say, but I do like Disney. It's value, which obviously you all know that's what attracts me to a lot of stocks is value. If we look at Disney, and I can bring up the stock here, we look at Disney, from 2021, from that peak of 190, it's down to 80. So it has lost quite a bit of money. The statistics here, if we let's look at price to sales, that valuation metric down to 1.8 times price to sales. It was as high as 2.2, so 2.2 times. And I bet if we look here on Morningstar, we get a little bit longer term picture on the price to sales for Disney, and what is more reasonable, what is more fair value, I guess, for Disney price to sales. Go here to valuation. I like to look at this because it gives you that 10-year price to sales that you can really compare where it's at now with what's maybe a little bit more typical of the company. So we see here 1.8 times price to sales. It was 4.2 back in 2021, 5, 3.5, 2.8. So it's not necessarily that it always trades at 5 or 4, but even going back, it's usually around 3 times price to sales, and right now about 1.8. So this is something that if it gets its mojo back, Disney could double in price pretty quickly. Now, of course, they have to work out some of their legacy media stuff like ESPN, what they're going to do with that. Some of that other stuff they have to figure out streaming. Obviously, competition is pretty heavy, hot and heavy in streaming, but I think they are one of the two streamers to own besides Netflix. And yeah, I mean, value investors. There's a lot to like here with Disney right now. It might take a little while, for them, to get that back, but it's a good price for Disney there. What else? Thoughts on JQ? Disney is supposed to sell ESPN. Yeah. Um, it's interesting because ESPN has always been really a strong driver for Disney, and now they're talking about selling it. Obviously, taking some kind of a different direction in that. Um, so he's saying, baptism saying ESPN fell off because of YouTube. I know YouTube, and well, Twitter was making pretty good inroads into professional sports. A lot of the streaming sports and things like that kind of fell off here over the last year, obviously with different priorities. But yeah, YouTube has been signing the professional sports streaming rights right and left, and has taken a lot from ESPN. So I think that's obviously hurt Disney. And yeah, maybe they just want a little bit different direction outside of these legacy media ideas, and this is probably a good time to do that. Okay, Marvin wants to know thoughts on DVN or AGNC. Okay, so DVN, Devon Energy, right? One we made a lot of money in just a couple of years ago when energy did really well over that year following the pandemic. It's still, it was one of my favorite drilling companies there. It's got a lot of shale exposure, which I think is still doing well, though shale is slowing down. The production in shale is slowing down quite a bit. But I think right now, really with energy stocks this year, I've just been playing them in that range. Okay, anytime crude fell below $70 a barrel, and a lot of you out there in the nation, you've heard me talk about this. Not so much lately because oil has been so high. It really ran up there 80 $85 a barrel. It's a little bit further down now, but it's better part of the year it was trading back and forth between 67, 68, $70 a barrel up to 85. So I would buy a lot of the energy stocks right around 67, $68 a barrel, sell them when oil got back up to the top end of that range, right around 85. Now, for the longer term investors, obviously you want to go with a lot of the shale drillers, a lot of the ones that had the lower cost of production, like Devon. I think Devon is a good one. It cut its dividend. That sent the shares down quite a bit lower, just to protect that cash flow. But here, I think $80 a barrel, and once we get beyond this recession fears, which is over the next year and a half, I mean, you're going to see oil go back up to 85, $90 a barrel, maybe even 100. I think Goldman Sachs has it at like $110 dollars a barrel over next year. And that's going to be really supportive, obviously, of these cash flows, of these buyback programs for things like Devon, for Diamondback Energy. We've also invested in them. Chevron is probably my favorite in the energy space just because it's larger, has a little bit more flexibility. Obviously, it's not gonna do as well as Devon Energy because they have a lot more company to move there with Chevron. But I think it's a safer play, and you know me, I'm all about those safer plays. So Devon Energy, great energy company. If you're a little bit more risk intensive, if you want a little bit less risk, I'd probably go with Chevron. With AG&C, mortgage REIT there, mortgage REITs are obviously a lot of uncertainty there just because of the mortgage market, mortgage rates as they are. I'd have to look a little bit more into that because it's been quite a few months, I think, since I've looked at AG&C and kind of the spreads. What you really want to look at is really the spreads between the mortgage investments that they're buying, so the mortgages themselves, and the money that they're paying, those short-term rates that they're borrowing on. And what's been the problem for mortgage REITs like AG&C and even banks in general over this last year is that those short-term rates, so that short end of the yield curve has been so high. 2-year rates right now like over 5%. The long-term mortgage rates, even though they are slightly higher, 7%, and so 6-7% on the long-term, the 30-year rates. Then they're not that high enough. They're not high enough for that spread, that margin, that profitability to really make these companies profitable. So obviously, they're facing difficulties in that, and we've really got to see that change in the yield curve to where the short term rates come down. As we get closer to the Fed cutting interest rates, right? When the Fed does start cutting interest rates, and maybe even a little bit before that, the market will adjust in preparation for that. But when the Fed starts cutting interest rates, then that short end of the yield curve, the monthly T bills, the 2-year T treasuries, those will start coming down. The higher interest rates, the longer end of the curve, the long term rates, so 15 years, 30 years, that kind of thing, will go up. And you'll see a lot of these mortgage rates, you'll see even the banks start to react very favorably in that. So that's probably going to be the time to really start investing in those mortgage rates, in those banks, those financial companies, and even in real estate. When we get closer to the Fed cutting rates and that yield curve kind of goes back to sloping. Uh, any thoughts on AbbVie? AbbVie, haven't looked at AbbVie in quite a while. Used to be a very strong stock. With drug makers, though, you really got to watch the pipeline, and if you don't look at them over 3 to 6 months, then that pipeline can get old, and you can kind of lose track of what they've actually got coming in the pipeline. So with drug stocks, obviously the big news lately is the weight loss drugs, Ozempic, with I believe so. Novo Nordisk has one, the Monjaro, and then Ozempic is owned by Eli Lilly. So those are the big stocks to own right there. And then who else is developing those? I believe Pfizer is developing a weight loss drug that might do well also. Okay, you think Asia? So do you think AT&T should kill off its dividend to pay off debt? I read something that to that effect on Zacks. It's interesting. I don't think they should kill off their dividend. Obviously, I think a lot of investors are investing in AT&T and Verizon for that dividend. So if they completely did away with the dividend, it would probably kill the stock. So I don't think that is something they need to do. Obviously, I think AT&T cut its dividend. Verizon has managed to hold theirs up, but is very tenuous on that. But yeah, with both AT&T and Verizon, if you look at those, the cash flow on those, you really need to start looking at the cash flow statement on AT&T, on Verizon, because not quite as much for AT&T, but especially Verizon. If you look at the cash flow statement here, then you'll see what's really troubling. And this is, if you remember Warren Buffett's worst investment ever in IBM, this is really what he failed to see, and why IBM lost him so much money is that it was financing its go to the cash flow statement here. It was financing its dividend and share buyback program for so long with debt that it just built up insane amounts of debt. Okay, so you see here the operating cash flow. So this is the cash flow actually generated by a company. This is so much better than just looking at the net income of a company. You look at the operating cash flow, the actual cash generating power of the operations of that company. You see here So it's been pretty consistent, 35, $40 billion a year, about 37.5 billion over the last year. Investing cash flow. Now, most of this is the money that the company has to spend to keep to keep the business running, right? Or even grow it a little bit. Within this is capital expenditures. It's going to be those capital expenditures are the money it has to pay just to keep the company going, right? Upgrades in equipment, uh, maintenance, that kind of thing. This doesn't even include the things that to grow it, like the 5G, 5G stuff and all that, which you really see an increase here in 2021, where it had to buy that 5G bandwidth. There's $67 billion that year. But if you even look, the regular years here, 24 billion in investment, 28 billion, 23 billion, and if you take out the operating cash flow minus the capital expenditures. So not even all of this investing cash flow, but just the capital expenditures, just the amount of money AT&T or Verizon has to spend to keep operations going. That's your free cash flow, right? Now, what you want to do here, you want to look at free cash flow compared to what it's spending on on the dividend and dividend and other things, right? Dividend if it's paying off any debt, things like that. And for the most part, a lot of these years, it is just barely able to cover its dividends paid. Even and that's free cash flow. If you remove all the operating cash flow, all the investing cash flow from operating cash flow, a lot of these years it didn't have enough to cover those dividends. So it had to issue debt. You see here, this net issuance payments of debt. Okay. A positive number means it's issuing debt. And you look over the past 4 years, how much debt, well, okay, they paid off $5.2 billion in 2019. But these last 3 years, you look at how much debt Verizon has had to issue. And if you look further out, maybe something with like Morningstar, it is just issuing so much debt just to cover this dividend. It's not even paying off any debt. I know AT&T is able to pay off some of its debt just because it has a little bit better cash flow. But if you look at things like that, I mean, you start to get a picture that, okay, is that dividend sustainable? Can it keep issuing so much debt? Can it issue debt forever and continue to grow that dividend? Probably not. So I would be very leery, very wary of both AT&T and Verizon, but more so with Verizon and that dividend. They're going to have to slow down that dividend growth, even maybe even someday cut the dividend to start paying down that debt because they can't just build debt forever. Um, what else Joseph, so you did, where are we here? Okay, Daniel, so you did exit your ape play once it hit 220, or are you waiting? No, I exited ape, so I bought ape shares. I think I was right around $1.46 that I was in ape. I exited. Actually, it was under 220. I want to say like $1.96. I did miss the top on the ape shares. The ape shares hit something like 226, 240 or something just a couple of weeks ago. I missed that, but I'm pretty good. I'm not mad at the money that I made because I was just in it for a short-term trade. I didn't want it to hit another lawsuit and fall again and have to wait it out further. So yeah, I exited right around $1.96, 220, somewhere around there. But yeah, definitely would not be risking it right now in either of those AMC or APE. Okay, we are coming up on almost an hour and a half. I got to get my son to coding school. It's Thursday, so I appreciate everybody being here. Be sure to get your free report, my Forever Stocks, with that link to that in the chat there, or in the description below, or in the comment. I'll put it there. Uh, I'm gonna put the analysis, the video to link here. Check that out. Again, if you're new to the channel, join the community. Tap that subscribe button. It's free, and you'll never miss an episode.